Hey guys, I'm Corey and this is Tiffany.
We're the co-founders of Investor Life.
And we help investors scale their portfolios using other people's money.
In today's video, we are talking about the top ways that real estate returns a profit. Because the best part of it is that there's not just one way, there's 4 ways, multiple streams of income that real estate brings us.
So way number 1, and this is really, really important, is to make sure that your properties cash flow. That's what keeps us in the game long enough so that our properties actually make us money.
Yeah. So what's cash flow? Really simply, it's your rent minus your expenses. But there's a catch. Sometimes we don't know what we don't know. And so as newbies, sometimes we forget about some of the extra expenses that are a reality as investors.
So let's run through an example just so that you're clear as to what kind of expenses you should be including with your numbers. So on an average property, let's pick a number of $300,000. You're going to put 20% down, which is roughly $60,000. And your mortgage payment then on that $240,000, the 80% loan to value, is going to be $1,011 if we're using 3% interest. Okay, so what are some of the other expenses? Sometimes people just forget and used only the mortgage payment. What are some other expenses? Make sure that our insurance, our taxes, our vacancy allowance, and our repairs and maintenance are also included.
So most people know about, what's called PITI, so principal, interest, taxes, and insurance. And most people count those in. However, what people don't realize, and no matter how much of a good property manager you are, no matter what kind of a market you're in, you're going to have vacancy at one time or another. And you have to count on that, because if you don't, you will be stressed out. Your bank account will be affected and you will want out of the game. So mortgage payment, yes. Taxes, insurance, absolutely. But you also need to count in a vacancy rate. Now, where do you find that? You can go to your local real estate board. You can go on different rental websites and look right in that area. So don't look outside of it, look in that area and find out what's the vacancy rate. And then be realistic. Don't say, oh, mine's way better. My property's way better, so I'm not gonna have that. Be realistic and put the proper percentage vacancy rate that you wanna plan on. That way, you always have money staying in the bank to take care of stuff like that.
So these are the numbers that are extremely important to understand when you're trying to figure out your cash flow, because your cash flow keeps you in the game long enough for your real estate to turn to wealth. So Tiffany mentioned vacancy allowance is one that a lot of people forget. Another one that a lot of people don't take into consideration is your repairs and maintenance. So make sure that you have a percentage put aside to build up a reserve so that when things do go wrong, when repairs are needed, you have that money sitting there to enable you to do those repairs.
So a lot of people say, what is a good standard rate for that maintenance account? But you know what? There isn't really a standard. It does depend on the property. If you have a brand new property, you might not have to put in any maintenance, or maybe just 1% planned for. But if you have an older home where things go wrong and have older appliances and that sort of thing, you might want to count in a little bit more, at up to 8%, 10% we sometimes see in older homes, but make sure to count in those kinds of things. What other things can you count in are things like tenant gifts, or bookkeeping fees, accounting fees, banking fees. Those kinds of things come out of your bank account, so you might as well account for them.
Okay, so let's run through those numbers on how it would work on that example that we talked about earlier, the $300,000 property. Let's assume it rents for $1,750 a month. Here's the expenses that we'd want to make sure that we take off of that and we're accounting for when we're looking to buy that property. Number 1, your mortgage payment, just over $1,000 for that. Number 2, your insurance. So $75, let's take $75 a month for your property insurance. Let's take off your $150 a month for your taxes that you would pay on that property. Let's take into account your vacancy allowance of 5% of your gross rent, $87 a month. Your repairs and maintenance, 5% of your gross rent, which is $87 a month. And don't forget to take off and account for your property management. Even if you were planning to manage it yourself, you still want to account for that cost. So a 10% property management fee in that case, and that might go to you if you're managing it, but that would be about $175 a month in this scenario. So after all of those expenses come off, what are we left with? we're left with roughly about $160 a month. That is what we consider cash flow. The fact that you're making money every single month off of that property and that is going into your bank account, it is bringing your bank account balance up after all your expenses have been paid. That's when a property cash flows.
So a really important note here is that when a lot of people do their numbers, they would have this property cash flowing not at $160 a month, more like $400 or $500 a month. But that's not reality, and that's what's going to stress you out and kick you out of the game really, really quick. When you have cash flow, real cash flow, interest rates going up, you're protected from those a bit. Market issues, you're protected from those a bit. Rents going down, you're protected. So make sure to do your cash flow numbers properly.
Yeah. Okay, point number 2, important point when it comes to ways that we can win when it comes to real estate is mortgage pay down.
So mortgage pay down, it's probably my favorite and one that I didn't really know about when I came into investing. And the concept is simple. It's, if you buy a house and you put a tenant in it and they rent it off of you for 25 years, at the end of that 25 years, you'll own a house free and clear. So you didn't have to pay off that mortgage. Your tenants paid off that mortgage. Very powerful and an amazing return on investment just from mortgage pay down alone. So that is the second way that real estate turns a profit and another stream of income.
And that's a way that a lot of people forget about because you don't see that money going in your pocket. The mortgage balance just ends up going down over time.
Yeah.
So it's something that's a lot of times forgotten about, but extremely important when it comes to real estate investing.
And it accelerates as you get longer. So the first 5 years of your mortgage, you don't really pay all that much down. Most of it's going to interest. But once you get into that 10-year mark, 7 to 10-year mark, then most of your payment is going to the principal, not the interest. So that's when the power really comes to you, and that's where you start to really see that equity increase and head toward that more wealth kind of stuff.
Okay, point number 3 is equity appreciation.
So appreciation, there's 2 different kinds. One is a natural appreciation. That's what markets do. Generally speaking, if you look back 100 years in real estate, in almost any market that you can go into, you're going to see that real estate has gone up. That's a natural appreciation. It outpaces inflation. It outpaces the stock market. It's natural inflation. So that's what our market does without us. And that's usually somewhere where we see investors also trying to be a little bit too optimistic. So be careful there. Make sure to put in, what is your market going to be going up? How much? You can find that out from your local real estate boards. There's projections. And then be a little bit conservative when you run your numbers so that there's no disappointments.
And of course, that's something we can't always count on. Markets go up, markets go down.
Always.
And if we bought at the peak and it starts to go down, we're getting negative equity appreciation in that case, negative natural appreciation. But over a long period of time, that's where this comes into play. Over a long period of time, like Tiff said, in North America, our average over the last 50 years has been between 5 and 6% in Canada and the United States.
But
over a 50-year period, 5 to 6% every single year if you were to average it out. Now, does it do that every year? No, there's ups and downs.
Yeah.
But equity appreciation is really where you can make a ton of money in real estate investment.
So here's the thing about that is you don't want to be trying to time the market. If you try to time the market, you may be right sometimes, but when you're wrong, it really, really hurts. So you're not going to time the market. You're going to just spend time in the market, okay? And if you're cash flowing, whether the market goes up or down, it doesn't matter. Your cash flow, your property's still paying you every month the same amount. That allows us to stay in the market, even in those downtimes, waiting for those up times to come. So that's when your cash flow actually turns to wealth, is through that natural appreciation, through the time in the market, your pay down, and keeping that cash flow nice and level.
Point number 4. Point number 4 is forced appreciation. So we're going to up the value of a property by doing some work on it, maybe buying an undervalued property, or by doing renovations, we're going to increase the value if we're doing some of that sweat equity ourselves.
And just a note on that, neither of us are really good at renovations.
I hate renovations.
I love them, actually. I enjoy them. I'm not good at them, but I enjoy them. But you know what? That's not our business model. But we can still buy properties that just look really gross. Maybe it's cleaning, which we don't do anymore ourselves. We used to. But you can hire that out for fairly inexpensive. And then painting, again, fairly inexpensive, but you can change the whole look of a place just by doing those few things. So I'm not talking about busting down walls and creating big projects for ourselves. This appreciation that you force can be done in small bits, and you can really, on the buy, make quite a bit of money that way.
Lipstick and rouge, that's usually what we call it. You know, you can just make it look a little bit better by putting some lipstick on it, and
So,
that's
like,
what Tiff's talking about.
That's like me. Like, I haven't gotten plastic surgery. I'm working with what I've got, though. I'll put on makeup, and I'll try to contour, and I'll try to do all this stuff. I'm not going to go get plastic surgery, but I will try to emphasize or work with what I do have. So same thing with the property. You're not going to knock down walls necessarily, but just by working with what you have and making that better, it's amazing how much you can make on the buy and, you know, in renting it out.
So that's the beauty of real estate, is you have multiple ways to win.
Yeah.
You have multiple ways where you're going to gain a profit. So point number one we talked about was your cash flow. That keeps you in long term.
Yeah.
Point number two was your mortgage pay down. As time goes by, that money, that mortgage that you have is being paid down by your tenants, not by you. Point number three was equity appreciation or natural appreciation from the market going up in value. If you're in long enough, because you had cash flow, that value of that property should be going up. And then point number four was forced appreciation by doing renovations, by doing that sort of thing.
The best part about it is that this actually accelerates over time. It gets faster.
And it's a lot shorter than you might think. On an average 25-year amortization, you're going to end up paying more towards principal in less than 4 years. That payment starts going towards principal more than the interest you're paying, believe it or not. And on a 30-year amortization, it's more around the 8-year mark. But the point is, you end up starting to pay your principal. More of your mortgage goes towards your principal than your interest a lot sooner than you might think.
Pretty powerful. So if you found this video helpful, please subscribe. Check out the other videos that are in the description, in the link below. And, you know, happy investing. It's a great game if you know how to do it properly. It can really reach all of the dreams and plans that you have for your life. So happy investing.